Hi everyone, this is Roger. So today I want to talk about FAANG stock. FAANG is an acronym that refers to the five of the prominent US technology company. Now F for Facebook, A for Amazon and Apple respectively, N for Netflix, and G for Google. So hence FAANG. So in the past, we always think FAANG company or FAANG portfolio is a good representative of the US technology sector. Uh, and especially when we analyze the stock market, FAANG is big part of the uh, a very good representative of the index, right? So how big is FAANGs? At a high level, probably uh, let me tell you that at of August 19, 2021, the market cap of the five company alone, uh, combined market cap is around like 7.1 trillion. Also today we're going to talk a little bit on the stock, the five company as well as the performance and the risk. This is not a financial advice, just a little bit of disclaimer to you. So let's move to the next slide. Oops. So a quick overview on the FANG stock, which is the stock for the five company. You will see that you range from $3,000 per share, Amazon, to probably like Apple, which is about $100 per share. So uh, you can see that from 2013, which is the start of this data set, it has been growing tremendously, and this is happened for all of the five uh, uh, entity, right? Of course, we are not able to see the strength of the trend for all the five, because this is an absolute amount based on the share price itself. Uh, if you see from 2013 January, there's no um, the starting point is all different, right? We are not able to see the slope or the strength uh, of the of the increment of the stock price, right? Uh, so at this moment, we can see that the, the the share price is growing, in the 8 years, right? So maybe we talk about the risk before we talk about the return. Let's talk about the risk first, right? Now, FANG, just now we see that it's growing. All of them are growing, but does it come with risk? The answer is yes. You see, so I plot a few charts here. Um, each chart represent a company, right? So for the first one is Amazon, the second one is Apple, and for each of these charts, right, we'll look at the volatility of the stock, which is represented in red color, versus the general market. In this case, we use S&P 500 as a proxy for the general market. I use a light blue. So if you look at the charts for the first five charts, you will see in generally red color always dominates, or is more strengthened than the blue color, which is the general markets, right? So it means the volatility of the tech stock is much higher than the general markets, right? When it go down much deeper than the general market. When it going up, it's going up much stronger than the general market. Now, however, I see one single exception throughout all the company. On which date? Which is on March 2020. If you look at March 2020, the general market dropped more than Amazon. Same for the Apple. Same for Google. Same for Facebook. and it's definitely same for Netflix. So this is actually, I would say, a one-off event, right? There was a COVID outbreak in US, and the general market is not doing well during the time. Of course, when people work from home, they rely more and more on the the tech, right? The social medias, all this stuff, and therefore you will see that even though during the period this five company it dropped a little bit, but it's not as much as the general market, and I will say that this is the only exception you will see in the charts, right? Now the last chart here is actually looking at Nasdaq 100 index versus S&P 500. Now, probably most of us know that most of the technology company are listed in Nasdaq, and Nasdaq 100 it means the top 100 technology company in Nasdaq, right? Which most of them are technology company, right? And something interestingly to see is the volatility of Nasdaq, which is a tech company, is actually quite consistent with the general market, um, which is quite interesting because if the argument or the hypothesis of a technology is much volatile than the general market, then the index will resemblance the kind of the risk or appetite. But of course, another argument is, of course, we are saying that when you have more than X amount of stocks in your portfolio, you will somehow diversify the risk, and your risk is somehow consistent with the general market. That's one of the hypotheses we are looking at. But of course, in this case, we are seeing that in general, the volatility is more or less the same with the general market, and therefore, I think is the Nasdaq 100 is more or less proxy of the markets. Yeah. So after we talk about the risk, let's talk about the performance. Now, just now in our previous slide, we just show the charts with the share price. We did not compare apple to apple, right? And in this slide, we assume all of the company having the same starting point. It also means that in the 1st of January 2013, we are buying probably $1,000 for each of the five company: Netflix, Facebook, Amazon, Apple, Google. Right? We put $1,000 in each of the stock, and we leave it there. We don't look at it. What happened? Right? We track the so-called the P&L, right? The profit or loss over the time, right? So what happened is, if we do that in 2013, so who's the winner? Who's the winner? So the winner is Netflix, right? So if you can see from here, when everyone start from zero, and when you come to here, which is on the end of August, you will see that Netflix actually gained about 400% over the 8 years, right? 400%. Oh, that's very incredible. And the lowest amount of FAANG is Google, which is 237%. So even the lowest we can see also is about 200% over the 8 years. So let's take a look on the S&P, right? Let's see what happened if I invest in the overall market. I buy a ETF in S&P 500 in 2013, and I leave it there. treat it like a fixed deposit. I I revisit my portfolio in the end of the August 2021, and I will see that the S&P 500 is also not doing bad. It's about 124%, right? This is as of 24th August 2021, right? But of course, the I mean we will see that the FAANG is much outperform compared to the overall markets. So I was of course when we look at the volatility of the stock, meaning the risk is much higher. So probably in the short term you will see some of the stock is actually negative, making losses. You see, exception with Netflix, we have a huge start off gain in 2013. You will see most of it is not doing very well. I mean, it's doing decently. Some of it also making losses, like you can see from here, 3 months down the road, you have Facebook is making 6% losses around there. Apple is making about 17% losses, right? Others like Amazon is about 4%. Is still not outperform S&P 500. In this case, S&P 500 is already 6.7%, right? So probably we can see out of the 5 FAANG stock, only Google and Netflix is outperform. But of course, when we look for longer term, the, the risk payoff, right? I mean, the return is more than the risk, right? So that's all today. I want to share some of the perspective of FAANG stock. Probably in the next time we'll share a little bit more on the predictive of the stock, right? Thank you.